Hello everybody. Today we are going to discuss an example of capital budgeting, and I hope you have gone through my previous video on cash flow preparation where I showed you how to do a simple capital budgeting exercise. This one is a little complex. So this is a scenario where a company has to decide whether to introduce a new product or not, because this company already has existing products. So you will be given data in the following form. You can see that you have been told this new product that is going to be introduced is going to have a life of 5 years. And expected sales are given to you out here. Machinery cost is going to be 100 million. Depreciation will be charged at 25% written down value method. Salvage value of the machine after the end of 5 years is going to be 20 million. Working capital requirement is 20% of sales. So this is a little different from our earlier example. And this working capital is going to be liquidated at par after 5 years with an estimated loss on account of bad debt of 5 million. In other words, you don't expect this 5 million to come back. Tax rate is given as 40%. You are also told that raw material is going to be 30% of sales, variable labor cost 20% of sales, fixed annual operating and maintenance cost is 5 million, overhead allocation is 10% of sales. This line in red color is important. It is said that while the project is charged an overhead allocation, it is not likely to have any effect on overhead expenses. Which means that on paper you have written that yes, there is going to be an overhead allocation. All right. But in reality, you don't have to spend anything extra in the name of overhead. So therefore, your overhead expenses are actually zero. And because you are using common facilities, remember there are already existing products out there. So because you're going to produce this new one, it will mean decreased production of other existing products. So you are going to have a loss of contribution of 15 million every year. And this is an opportunity cost. So with this data, you will have to go ahead. The first step is always to prepare the depreciation table. Year 1, your machinery is valued at 100 million. So if you depreciate it at 25%, the depreciation amount is 25 million. Subtract this 25 from 100, you have 75 out here. Then you apply 25% on the 75, you will get 18.75. So in this manner, you will calculate the depreciation table. This discount rate is given to you should you wish to calculate your NPV. So once we have done the depreciation table, we will now go ahead and prepare the cash flow table. So these are the years from 0 to 5. Machinery 100 million. So no problem in that. All right. We have written this 100 out here. Now this net working capital is going to be as percentage of sales. Please understand that if you want to sell 100 million in year 1, all right, you will have to arrange for working capital the previous year. So which means that this 20 which I have written out here is actually 20% of this 100. Similarly, for 150 revenue in year 2, you must arrange working capital in the previous year, that is year 1. So 20% of 150 is this 30. Similarly, 20% of 200 is this 40. 20% of again 150 is 30 out here. And 20% of this 100 is this 20 in year 4. So this is how you will get the level of net working capital. And this last 20 that you have is going to be liquidated after 5 years. I have color coded it blue out here because this is not going to be used in the actual calculation as of now. But yes, it does have a role towards the end of the table. Now we will proceed as we did for the regular capital budgeting exercise. Remember the last video where you saw how it was done. So you will start with your sales figure, the revenue which is given to you. From there you will deduct raw material. Again, your raw material was mentioned as a percentage of sales. So it was 30%. Therefore, all these figures that you get here are 30% of your sales. Labor cost was given as 20% of sales. So you can see these figures here are all 20% of sales. Fixed cost, you were told 5 million every year. So it is here. Loss of contribution, we mentioned it is 15 million every year. So that is also a loss out here. And then depreciation, remember you calculated the depreciation. So we will just plot the values out here. You do not have any overhead expenses. That is why I have written 0 out here. Now remember you had the bad debt loss which is going to occur in the last year. Alright. Bad debt can be treated as an expense. So it is a tax deductible expense and therefore we have placed it out here. So from revenue, if you deduct raw materials cost, labor cost, fixed cost, loss of contribution, depreciation, overhead expenses and the bad debt loss, you arrive at a figure called profit before tax. And as explained in the earlier video also, the interest is not to be deducted out here. Now from profit before tax we are going to pay the tax. A tax rate has been given to you and it is 40%. We have mentioned out here it is 40%. So we are going to calculate our tax 40%. Alright. After you calculate the tax, then you subtract it from your profit before tax, you arrive at profit after tax. To this profit after tax, we will have to add the terminal value which comes only in the last year. So this last year we are getting is terminal value of 35. Where are we getting this from? Remember we said the machine will have a salvage value at the end of 5 years, that is 20. Okay. And another 20 was supposed to be liquidated from your working capital. But we said 5 is a bad debt. So this 5 is out here. Okay. Which means that balance 15 will be there available. So 20 plus 15, this is 35 out here. And now we will calculate the cash flow after tax. So we know that cash flow after tax is profit after tax plus depreciation. And in the last year, we also have to add the terminal value. But in this case, we are going to add another extra value in the last year. And that is that bad debt which we had subtracted earlier. Why are we doing this? Just as we add back the depreciation, because it is not really a cash outflow, in the same manner, this bad debt loss which we accounted for is not actually a cash outflow that is happening. So therefore, we are adding it back out here. So in this manner, we get the cash flow after tax. Now there's an additional thing to be done. Remember we had this level of working capital which kept on changing. We have to take this into account. You can see that from 20 million in year 0, it became 30 million in year 1, which means that there was an addition of 10 million. So extra 10 million we had to spend in the name of net working capital. 30 increased to 40. So again another additional 10 million outflow we have. But from 40 it reduced to 30, which means that we have saved 10 out here. And from 30 it became 20. So there's another saving of 10 out here. This difference we are going to take into consideration. So this 10 in year 1 is because of a difference of 30 minus 20. In year 2 it is because of the difference between 40 minus 30. In year 3 it is minus 10 because of 30 minus 40. And in year 4 this difference is coming because of 20 minus 30. So this net change in working capital, please understand that in some years we had to spend more, so that was an outflow. In some years we had to spend less, that negative one is spending less, which means that there was a saving. All right, so this has to be incorporated. So in the net cash flow after tax, what we are doing is, from this CFAT we are subtracting this change in the net working capital. Therefore, for first year, although you have a CFAT of 28, but there was an extra outflow in terms of net working capital. So this 10 has to be deducted. Therefore, you get a 18 out here. Similarly for the second year. But in the third year, what happened? This minus 10 means that we did not have to spend extra. Rather, we saved this amount. So therefore, 53.63 minus of minus 10, you will get 63.63. And similarly for year 4. Year 5, no issue because you do not have any change out here. And in this manner, we get the net cash flow after tax. On this net cash flow after tax, we are going to calculate our NPV and IRR. Remember, we put in a discount rate of 10%. All right. So you can use the NPV formula, which is given in the Excel sheet out here. And you can see that I have put in N15. N15 is where the discount rate was mentioned. And C44 to H44 is cash outflow followed by cash inflows, and that is giving us our NPV, which is a positive number. You can also use the IRR formula in the Excel sheet, where you are going to first mention the entire cash flow. All right, starting from your outflow followed by inflows, and then I have put in a 0 out here. 0 is the guess number, as they say, which means you can guess any interest rate and the machine will calculate on its own. So I have just put in a 0 out there, and our IRR is working to 20%. So this is how you will calculate the NPV and IRR. I hope you have followed this example, and yes, it is a little tricky as compared to the previous example discussed in my earlier video. Thank you very much for tuning in.